The latest CPI data has once again come in hot at 3.2% on a year-over-year basis, exceeding expectations of 3.1% and also rising from last month's figure of 3.1%. This piles even more pressure onto the banking sector, who desperately need interest rates to start being lowered, as it reinforces the fears that inflation is not under control yet and increases the likelihood of delays to rate cuts. Now, Jerome Powell himself even came out last week and said definitively that there will be bank failures as liquidity issues and underwater loans, particularly in the commercial real estate sector, continue to be massive problems for many banks. Now, interest rates staying higher for longer only prolongs the pain that many banks are feeling at the moment, whose loans and other assets remain worth far less now compared to when they took them on. And this is just one more thing to add to the storm of other economic headwinds that the industry is facing at the moment. One of these major headwinds is the termination of the Bank Term Funding Programme, which as of the 11th of March is now closed for any banks that may need emergency funding to avoid collapse. Now, the programme was originally established in the wake of the March 2023 banking crisis, in which Silicon Valley Bank and numerous other banks collapsed off the back of underwater loans and the confidence amongst customers and investors falling drastically. With the Federal Reserve now deciding to put an end to this tool, which has been a vital source of liquidity for many regional banks, it raises big questions around whether the US financial system has the tools it needs to stay liquid with enough cash on hand to avoid more trouble. This is especially the case considering that the total value of current loans given out across the Bank Term Funding Programme has been steadily rising ever since it was introduced and are at highs of $164 billion right now. We know that the Federal Reserve is continuing to shrink its balance sheet at quite a pace through a continued period of quantitative tightening after years of stimulus that was intended to spur on a pandemic recovery. Now, the Fed's balance sheet is now at its lowest point since February of 2021, and close to $1.5 trillion has been removed from the system in the past 2 years. Now, with this liquidity continuing to be drained from the system as part of this tightening, it only increases the odds of more cracks emerging in the funding market, which could cause things to stall and bring on more carnage in the banking system. Now, Mark Cabana, head of US rates strategy at Bank of America, has said, even though funding conditions are stable, banks are still desiring elevated liquidity buffers. BTFP was just one reflection of this. Now, the banks that had taken out loans as part of this $164 billion in total, who had pledged US Treasuries and agency debt as collateral, must now either allow these loans to roll off or find another source of financing. How they do so will determine whether the amount of liquidity in the system remains plentiful and will impact on whether the Fed can continue its balance sheet unwind as planned, or if the process needs to be slowed down, and if it is slowed down, then this could have knock-on effects on inflation further down the line. And we know that these small banks are going to need to get cash from somewhere, as currently their ratio of cash reserves to total assets is below the reserve constraint level. Commercial real estate continues to be a massive problem for many banks, and one of the main reasons why we are seeing so many regional banks get into trouble and requiring emergency funding or just collapsing altogether. Now, the commercial property price index is down over 20% since 2022, but specifically the office real estate subsector is down substantially more than this, with many large office buildings only worth a fraction of what they were before 2020. In fact, 14% of all CRE loans are in negative equity, but this percentage rises to a whopping 44% when specifically looking at office building loans. As a result of plummeting property values and interest rates remaining sky high after rising so rapidly, we are seeing commercial real estate loan delinquencies rise to the highest that they have been since 2014. Small commercial banks have been consistently growing their exposure to commercial real estate loans over the last decade or so, and now hold about 2/3 of all of these loans. And some of these banks are extremely overexposed to commercial real estate, with CRE loans making up more than a 50% share of total loans in a number of different banks, all of which have a minimum of tens of billions of dollars in exposure. New York Community Bancorp finds itself at 5th place on this list of the most exposed banks, with 57% of all loans being in the commercial real estate sector, a bank that has of course been all over the news recently with how close they could be to collapsing. The stock of this bank is down over 60% since the end of January on the back of large losses, mainly to do with their massive exposure to commercial real estate in New York, which does include hundreds of millions in previously undisclosed potential losses. Now, as mentioned, Jerome Powell himself has even come out and admitted that there will be more bank failures to come from the commercial real estate troubles, however not at big banks. But with no more emergency funding in place, interest rates set to stay higher for longer, and commercial real estate not likely to recover anytime soon, how many of these highly exposed regional banks could collapse this year? The number of banks that have made it to the FDIC's problem bank list has grown by 8 and now sits at 52 total banks, an 18.2% increase since the previous quarter. Now, this is a confidential list that the FDIC keeps of all the lenders with significant financial, operational or managerial weaknesses. Now, the total assets sitting with these problem banks has subsequently risen by $12.8 billion to $66.3 billion. Although this list only makes up 1.1% of the institutions that the FDIC oversees, it is a continuation of an increasing trend that was started early last year, and this jump of close to 20% is quite a considerable spike in just one quarter. And in reality, this could be a vast understatement of what the actual number of banks and financial institutions that have significant weaknesses actually is, based on what Jerome Powell has said recently. According to Powell, the Fed have reached out to banks with high levels of uninsured deposits and high levels of office real estate debt, to which the Fed is examining whether they are being truthful with themselves. We do know that many of the loans on the books of many banks are dramatically mispriced to be overvalued, and in fact Senator Liz Warren responded to Powell by saying that he has gone weak-kneed on bank regulation and the American people need a leader at the Fed who has the courage to stand up to these banks. Ultimately, the data that is publicly coming out around problem banks is getting worse and worse by the quarter, which is bad enough as it is without the added ingredient of there potentially being banks out there who are cooking their books essentially due to less vigorous regulation from the Federal Reserve. This may well not be the case at all, however if it is, depending on just how badly these loans are being overvalued and hence the books are being overstated, this would throw in a whole load more pain for the banking sector on the whole. Quarterly net income across the 4.6k FDIC insured commercial banks and institutions declined by a whopping 43.9% from the previous quarter, down from $68.4 billion to now being at $38.4 billion. Net interest income is declining due to banks having to pay far more to customers who are depositing money with them. However, they are finding it harder to balance this scale on the new loan side of things due to tighter credit conditions. And while net income declines but remains positive for now, profits from unrealized gains are in deep loss territory, and the value of these unrealized losses absolutely eclipses operating profit. This is why banks are so desperate to keep hold of their underwater assets for as long as possible, and essentially for as long as they can until rates start to fall and the value of these assets rises back up. This is because being forced to sell these assets right now would inflict truly massive losses on their balance sheets, which when reported will throw fuel on the fire of the uncertainty and fear that investors and customers have right now around the banking sector, which could lead to a complete repeat of what happened in March of 2023, where we saw a number of banks completely collapse. But this time we could see the number of banks collapsing even higher compared to last year. And the banking sector is just one area that could have a lot of pain coming its way soon, as the stock market also looks to be in a once-in-a-generation bubble that could well pop at any time, causing shockwaves across the whole economy. I cover this topic in more detail in my previous video, which you can check out by clicking on screen right now. Aside from that, please leave a like on the video and subscribe if you enjoyed it, that does help out the channel a lot, and thanks a lot for watching.